So, Chapter 8. We covered the sales journal last time. Tonight we want to talk about the purchases journal, okay? Now, I'm going to put all these up here at one shot. In any company, you've got to have set procedures for the purchasing function in the company. Anybody here have a job, where you've got a purchasing department? Yes? And if you want something, you have to go to these people, right? And they have to sign off on it, and they issue a purchase order.
Yes.
So you make a requisition. You request from the purchasing department that I want something. We're going to sell these little remote control doohickeys, and I need 500 of them to put them on the store shelves. Someone is going to approve that and tell the purchasing department it's okay for you to order that. And then they're going to issue a purchase order and send it to the supplier. The supplier is going to send it to you. When it gets there, it shows up at the receiving dock and back. And it comes off the truck, and the guys pull it out and they count it. Why do they count it?
See what we got and if there were any damages.
Right. Remember, we ordered 500 of them. Did they ship us all 500 of them? Or on the document that they send, when they invoice us, it's going to say, well, we only shipped you 480. Did I get all 480 or did they short me? And did anything get damaged in transit? Because I don't want to pay for something that I didn't get or that's broken, right? Okay. So from there, they send a document, a receiving document to the accounting department, and they match up the purchase order and the receiving document so that they know it's okay to go ahead and pay the bill. So notice there's lots of multiple checks in here, double checks. One group is checking that it's okay, another group is verifying that it's okay, a third group verifies that it got here, and a fourth group actually pays for it. In a company without controls, anybody could pick up the phone and say, hey, send me a bunch of those. Imagine if your sales guy called up the vendor and said, hey, send me some of these, send me some of those, send me some of this. Nobody authorized him to buy it. Maybe they're things that aren't going to sell well. Maybe they're things that you don't want to carry anymore. Maybe he calls up and has them sent to his house. Right? All kinds of things can go wrong. That's why we have these double checks. Okay. This is a invoice from the style shop, and this is where we went out and we bought 10 men's suits. Okay? International Apparel Shop sold to us. We are apparently the style shop. We bought 10 suits. There's a couple of elements that I want you to be aware of here. This is a pretty typical invoice. There's a date for it, there's an order number, there's an invoice number. It tells us our terms. Remember we had a conversation about terms? What does this mean?
Net due in 30 days.
Net due in 30 days. Good. Repeats the terms. Net 30. Date shipped. FOB Dallas. Have we talked about FOB yet? No? Okay. FOB means free on board. And what that is it talks about where ownership changes, transfers from them to us. And with ownership comes risk of loss. So if something goes wrong, if the load is stolen, if the truck blows up, if they burn to the ground, who has risk of loss? If it says FOB delivered our dock, then they have ownership and risk of loss all the way to our business. Let's see, we're located in Dallas, so it kind of looks like they're delivering them all the way to us, and they have risk of loss till it gets there. So they're arranging freight, they pay the shipper, all that good stuff. Okay? They charge us for the suits, but they're also charging us freight. They charged us $360 to ship these to us. So even though they arrange the freight and they're paying the trucking company, we're reimbursing them for it. They're charging us this $360. And you add that to what the merchandise cost and you get your total. So stop and think about this for just a second. That freight element is part of our cost of goods when these suits arrive in our store. So let's say we sell these suits for $1,000 a piece, because they're nice, expensive suits, right? How much did we pay for them? Is our cost of goods $476 a piece? No, it's really $512. All of a sudden, I can't do math in my head. Okay? So the freight element is included in our cost to get them to us. Good? All right. Okay, so we're the style shop. They're selling it to us. So this is going to go in our purchases journal. Okay? Okay. When we buy things, it becomes inventory for our company, right? We're going to put it on a store shelf, we're going to sell it. Every purchase we make, though, the general ledger account that we're going to use is called the purchases account. The purchases account is treated, it's the first step in reporting cost of goods sold. Everything we buy goes into the purchases account, and at the end of the month, when we calculate ending inventory, we will move the purchases out of this account and either into inventory or cost of goods sold. And you'll see how that works as we go. Okay? I love it when this thing works real well.
User error.
Okay. More means less slides. They can get the slides. Okay.
Oh.
What?
Oh, okay.
Oh, okay. Otherwise, I could just narrate the slides. That's a good idea.
Keep
too.
going.
Keep going. All right. So, you guys remember all of our accounts. Assets equals liabilities plus owner's equity plus revenue minus expenses, right? The full accounting equation. Purchases account gets its own group. We have a new group, and it's cost of goods sold. Cost of goods sold really is part of your expenses, but because your cost of goods sold is a major part of all of your costs, we separate it out and we show it by itself as the first expense we're going to deduct. Yes, ma'am.
Does cost of goods sold only for inventory or retail, or does it use for services?
If you are doing a service, you don't have any inventory. Your inventory is your time, and you don't record that you have a limited amount of it. So it's only for when you're selling something. You know, if you're a manufacturing firm or a retail firm and you're actually selling an item. Okay? And that's why when we did the service companies in the first half of the class, we didn't ever talk about this. Okay, another account we're going to have is the freight account. Remember on that invoice we just got from the apparel company, whatever it was, the apparel shop? They charged us for the suits and they charged us freight. So the cost of the suits goes into the purchases account. The cost of the freight goes into its own account called freight in. And later on, purchases and freight in are going to get combined to form cost of goods sold, but we do record them individually as we go. Yes, ma'am, go ahead.
I was just thinking of a comparison where on the sales, we had the sales account and then we had sales tax payable. So it's two accounts equaling the one account's receivable debit. And then, so now you have a freight account and you have a purchase account, and the two of them together are going to equal the account's payable ledger? Okay.
Correct. That's exactly where we're gonna go. You've just narrated the next slide for us. Perfect. So, on those suits that we bought 10 of them. We made a purchase. The suits were $4,760 by themselves. The freight was $360. It's an expense to us. And those two together equals the accounts payable, which is our credit for the $5,120. Exactly, you nailed it. Questions on that? Okay. So, in the big real world, if you were doing this by hand, like we're learning to do here, and you posted these to the general journal, you would get a whole bunch of activity. Just like we had with sales, remember? We would have sales, you'd have accounts receivable, sales tax payable, sale, and a description, and a date, debits and credits and a posting reference, right? So if you're doing a lot of purchases, if you've got a decent sized company, this becomes a lot of work. You're making a lot of entries here, and each of these has to get posted to the general ledger at some point. So just like we did with the sales journal, we can do the same thing here. And we can use something called a purchases journal. And we're going to sort of take a shortcut in the process by putting all of those elements on one sheet of paper and then summarizing that at the end of the month and posting that to the general ledger instead of posting each transaction individually. Okay? So the purchases journal looks very much like the sales journal. Got some different column headers in it though. Date, who the vendor is that sold it to you, and we need to know this for accounts payable, right? Their invoice number, the invoice date, their terms. Why do we know that we need to know the invoice date and the terms?
You know when to pay them?
We know when we have to pay them, correct. Posting reference column. Accounts payable, which is a credit, remember it's a liability. Purchases, which is a debit, we treat that like an expense. And freight in, which is also a debit because it's an expense. Okay? So in this example, we've got transactions for the 3rd through the 22nd. At the end of the month, we total up the 6 transactions, and we've got $21,750 in purchases, $1,565 in freight, $23,315 in accounts payable. My 2 debits equal my credit, and you can just post the totals to the general ledger directly. Bypass the general journal completely, save yourself the effort of posting all 6 transactions, and you're good to go. Just like the sales journal, we post the general ledger account number underneath as the posting reference. Good? Everybody follow? So what's this posting reference column for then? Remember on the sales journal, we knew who the customer was. We had to post it to the customer's accounts receivable card. Well, these are vendors. We owe them money, so we have to post this to their accounts payable card. And when we do, we put a check mark in there. Now, here's a key point. We total this and we post this to the general ledger at the end of the month, once, right? Each day, at the end of the day, we want to post all of these transactions that have not already been posted to the accounts payable vendor cards. So that when we make a payment, we know how much we owe the vendor, right? If I waited and didn't post these to the end of the month, what happens? My accounts payable vendor card looks like I don't owe the guy very much money, when in reality I do. So you want to track that every day. You're posting this every day, this once a month. Just like I was talking about here. These go to the general ledger monthly, but they go to the accounts payable ledger every day. Are we good with that? That's a basic concept that runs through all the special journals. We've talked about credit terms already, correct? How they work? No? Okay. When we advance credit to our customers, we give them, it's called giving them terms. And typically terms are, you give somebody 30 days to pay, maybe you give them 60 days to pay. And the way that's noted, I want to go back to I'm taking a risk here with this projector. The way that's noted on the invoice is net 30. They're giving us, the vendor is giving us 30 days to pay. So they say, you owe me the net amount, the 5120, in 30 days from the date of the invoice, whereas there it is, date of the invoice. Okay? So that's the simple way to look at terms. Net 30 is one example. Sometimes a vendor will give you an incentive to pay him early. And in that case, well, I'm going to skip that one for a second and go to this. Here's a guy who's giving you terms net 10 days, or end of month. So this means you owe me 10 days from today or the end of the month if that comes first. Okay? I don't see that one very often in the real world. You do see this one though. This is what I was talking about a moment ago. This guy is going to give you an incentive to pay him sooner than 30 days. He's going to give me 2% discount off of the total invoice if I pay him in 10 days. I can still wait and pay him in 30 days, and if I do, I own the full amount of the invoice. I can't take a discount. And that's shown 210, net 30. Discount 2% in 10 days, net amount due in 30 days. Good? Okay. Oops, I went too far. Remember, these special journals are designed to save you time. You're entering the same information in the same format over and over and over again, so it's easier to do. It saves you a lot of time because you're summarizing it and you're only posting it to the general ledger once. Good? Okay. So if it seems like you're doing more work on the homework, check with me because we might want to talk about that. It should seem a little easier. What you may be getting, though, is more transactions, and that'll compensate for it because you should have time to do more transactions now. So, posting from the general journal. I'm going to jump through the slides, and we're going to go to the John Madden format here, okay? From the purchases journal. Note, we've already totaled it, and we've already proved that it's in balance. Debits equal credits. So, what we want to do is take our date, come down to the first account, which is accounts payable. Find accounts payable in the general ledger. On January 31, we're posting from P1, Purchases Journal, page number 1, the credit, 23,315. We add that to our initial balance. And notice the slide is wrong. Okay? So that would be 34,115, right? Okay. So you got to do the math right. We're accountants. Good? Okay. And then the next step, it's going to run through the whole job Madden version of it. The next step is you take your account number and you post it in this column as your posting reference showing that it's been completed. If you had this purchases journal and it only had the 205 filled in here, what would you know? You still need to post purchases and freight in, correct? Okay. So here's the freight in. Same thing, you bring the date down, posting reference purchases 1, enter your debit, calculate your new balance, bring your posting reference up, good to go. Yes, ma'am?
And is that again like the expenses where it doesn't carry over from the month before, there's not a balance because it clears out at the end of the month?
Yes, your purchases and your freight in are both temporary accounts in that they zero out. Okay?
Will we go over the closing?
Yes, we will before we're all done. That should be chapter 12, I believe. So it'll be a little while, but we'll revisit the closing procedures. Okay? Okay. Remember, think very old school. If we were doing all this by hand, even a medium-sized company, you need lots of people to do this. And because of those posting references, you can split this up and everyone knows where we are in the process and what needs to be done, right? So you can have multiple people do the work. Leaving those posting references gives us a great audit trail, though, to go back and audit it and prove that it was done right, or find a mistake should we happen to make one. And all your credit purchases are recorded in one place. If you had to go look for something, it's easy to look it up that way. Good? Questions? Are we excited? I'm excited. You're excited? I got one excited student. And a half excited student. All right, let's move on to the next thing. So the purchases journal, a lot like the sales journal. Let's go on to the accounts payable part of this.
I have a question.
Yes, please.
I'm having a hard time knowing, I mean, like on assets and liabilities and owner equity, the assets go up on the debit side and decrease on the credit side. But here I'm having a hard time knowing where, I mean, where these are. Are they are they liability? I guess I don't know. I'm just having a difficult time putting them in the right place.
So the question is, are they debits or credits, correct?
I guess,
Okay.
yeah.
Let's play around for just a moment, okay?
I mean, sales.
That actually erased, I can't believe it. Go ahead.
Sales would be an asset, or, that's what I guess I'm not understanding. Purchases are an asset because you're buying things?
Hang on,
No, that's what I'm thinking.
hang on. We have assets. We have liabilities. Owner's equity. We have revenue. Now we have cost of goods sold. And then we have expenses. Inside of cost of goods sold, we have purchases and freight in. Good? So what I want you to notice is that these are all expenses, and they all get treated the same. So let's walk through this. If we have debits and credits, assets increase on which side? The debit or credit side?
Debit.
Debit side. They decrease on the credit side.
Mm-hmm.
Liabilities increase on which side?
Credit.
Credit side. And they decrease on the debit side.
Uh-huh.
Owner's equity increases on which side?
Credit.
Credit side. And they decrease on the
Debit.
debit side. Okay?
Uh-huh.
Revenue increases on which side? Credit. Credit side. Decrease on the debit side.
Mm-hmm.
All of our expenses as a group increase on which side?
Debit.
The debit side. And they decrease as credits. So there's the key.
Okay. Where does sales fall in?
Revenue.
Revenue, okay,
Revenue increases on the credit side.
okay. All right,
Good?
yeah.
So the purchases journal is entirely revenues and expenses. There's no assets involved.
That is correct. Let's go back real quick. So in the purchases journal, you've got accounts payable, which is a liability. And you've got purchases and freight in. And purchases and freight in are both expenses, and your accounts payable is a liability. All right? Notice it doesn't affect inventory anywhere. And inventory only shows up at the end of the month when we figure out how much we have left. And we'll get to that later, okay? So does that get you where you need to be?
Yeah, I'm closer to where I need to be.
Okay. Eric. Okay, so we talked about that. Okay, accounts payable. So the part we haven't done so far, we've done the purchases journal. I showed you how that gets posted. The part we haven't done is how it affects the accounts payable with the vendor and the vendor's account, or the vendor card that we talked about. Remember the old school format where you kept track of it in a card file? Okay. So here we go. We bought those suits from, remember these guys, the International Apparel Shop? And they're also located in Texas. They gave us terms of net 30. This is their vendor card that we keep. And when we bought those suits from them, notice we had a balance where we had owed them from last month of $1,600. This month, we bought those suits from them on the 23rd. Our description is the invoice number. And we bought $5,120 in suits. Remember, accounts payable is a liability, so it increases on the credit side. We're going to credit their account, which makes our balance go up. The posting references is P1, Purchases Journal, page 1. And when you go back to the Purchases Journal, for that particular purchase, in that vertical column, you put that check mark in there. So that was the one posting reference we had not done yet.
So when is the balance due?
Yes, that's part of your notes here. Notice they cut it off.
It says on top. Oh,
Well, January 23rd, it says the invoice date was January 23rd.
Yeah, but the balance
Sometimes they
is
get posted
1,600.
several days after. Yeah, the balance, it needs to say in here when the balance was due.
Yeah.
There should be some detail. Given it's an example in the book, let's go with it for now, but normally you would have that detail so that you can track it.
what would you have, like the old invoice number and whatever the date was on that invoice or something?
These cards typically don't get closed out every month and go to zero when you start a new card. So it just keeps going. It shows you your continuing balance and the invoices that have not been paid. So you go and find the invoices that haven't been paid when they're due and pay them and mark them off as paid and you keep going. Okay? In a computerized system, it tracks all that for you and it'll give you a little report. Here's what you've got paid today or this week. So when you jump to a computerized system, it takes a lot of this manual stuff out of it.
So you can have several pages of the same vendor, which is a lot.
Yes, and once you've paid all of the ones on this page and you go to the next one, you can, move it to the back, keep going. Okay? Other questions? You guys are an easy group. Oh, I did want to point that out. Notice there's just a debit and credit column for the current transaction and a balance. There is no debit and credit column for the balance. There's only one column. And that's because of the assumption that if there's a balance there, it means I owe this guy money because it's accounts payable. All right? If it ever has a negative balance where you're owed a refund, you're circling. And that's to tell you that it's, you know, a balance where they owe you money. Okay? Like we talked about, you post to the general ledger once a month when you do the summary for the purchases journal, but you post to the to the accounts payable subsidiary every day. Because when the time comes, you know, what if this guy offered you discount terms? If I pay this guy in 10 days, I get 2% off, and I want to take advantage of that. If I only post to the account, to his vendor card once a month, I'm going to miss the discount, aren't I? So that's why you post to it every day, or one of the reasons. Here's the John Madden version of it. So date pulls down, invoice number and description pulls down, purchases journal page 1, dollar amount pulls down, calculate the new dollar amount, insert the check mark in the post reference column in your purchases journal to show that you've done this. Okay? Good? Moving on. Cash payments. This is the flip side. This time I'm not buying something from him, I'm actually going to pay him. In the instance where you're paying him, we haven't covered the cash payments journal, but that's where it's going to come from the other special journal, the cash payments journal over here. And take the date that you paid it on, cash payments journal, whatever page you're on at that point. This says 1, so it's the first page. We wrote him a check for $2,400. $67.20 minus $2,400 leaves us a balance of $4,320. Good? Everybody see how that works?
All right, is making a payment like that standard practice, or is that kind of off the wall, like should have been $1,600 or $67.20?
That would be nice, and that would be fairly normal. But this happens all the time. This guy says, all right, I'm at the end of this month, this is only, it's not even 10 days old yet, but I have the cash, I'm going to try and pay it down a little bit. Okay, that's fine. It makes it tougher for us because, you know, when we're tracking this in our world, we're tracking it against this invoice and that invoice, and now you kind of can't do that. All it does is it reduces the balance on this one invoice, and it leaves it with an odd number.
So how would you adjust the discount percentage rate? on your
Well,
vendor's card?
notice in this example, he didn't give us a discount opportunity. So we're not taking advantage of it. And if he had, maybe we would have paid the whole thing. But if you only pay part of the invoice, if he gives you discount opportunity, and you only pay part of it, you don't get it.
Well, yeah, but like, say it's showing a balance of so much money, but you're getting a discount if you pay it on time or before.
If I pay it in 10 days.
Yeah.
And notice,
So
I
how
didn't
would
pay
you
the,
require
I didn't
it?
pay the full invoice in 10 days, so I don't get the discount.
But if you were to, say it was just home purchase.
I think it's a hypothetical. If
Okay, my understanding of the hypothetical is we bought $5,120 worth of stuff, but we're only paying $24. Do I get the discount? And the answer is no.
But if there was net 10 discount or whatever on this, is there another place that you show the discount on another form?
Yes,
Okay.
yes, we'll
That's
get
what I think they're
Okay,
getting
I'm
at.
sorry, I misunderstood you.
Uh-huh.
Yes, but what the effect on this document, though, is we have to remove this balance. Even if we don't pay him the full amount because of a discount, we have to remove the balance showing that we don't owe it to him anymore. Okay? So in that case, you would record $5,120 as a debit and show 0 as the balance. And we'll get to some examples of that. Okay? Questions? Cash payments journal must be coming up soon. All right. So when we have, remember when we had the sales journal last week? If you have returns or allowances or discounts, we did not post those in the sales journal. Those got posted in the general journal, correct? Everybody remember that? General rule of thumb. If we have a purchases journal and we return things, those do not go in the purchases journal. Those go in the general journal. Just like when a customer returned to us, it went in the general journal. When we return to a vendor, it goes in the general journal. Okay? So there's always going to be a need for that general journal. Good? Okay. Hey,
Yeah.
follow me over to the
I'm
other board
following you.
sometimes. Wake up.
I'm hungry.
You're doing this for food. I'm not going to feed you if you do a crap job.
That's in the video, but
I can edit that out. Keep threatening me, and I have it on tape.
Oh, sick.
Oh, sick. Okay, so purchases returns go in the general journal, just like sales returns, when a customer returns to us, go in the general journal. When we had a sale and a customer made a return, remember, we did not directly reduce the sales account. We kept it a separate sales return account. That was a contra account. It was a debit. Well, this is the same sort of thing. Purchases, when we return something, purchases are an expense, so they're a debit. If we return something, we're going to keep track of our returns in a special contra account called purchase returns and allowances. And we're going to post that as a credit to that account. Right? Assume we get our cash back, cash increases, credit, purchase returns and allowances. And to know what our net purchases are, we have to take purchases and the purchase returns and allowance accounts and add them together. Okay? To determine the ending balance. Everybody follow me? Notice how these things are working very similar to what happened last week. Almost identical. And even the names are fairly similar. So just be careful while you're doing it that you're referring to the correct purchase returns and allowances or the correct sales and returns and allowances account. All right? I've seen people get those confused, so a little tip there. Good? Good?
Well, one's a contract expense and the other one's a contract revenue.
Yep. Let's, I'm going to write on the board while the fire truck goes by. I can't believe the eraser's working tonight.
it's kind of nice.
They're recording.
Editing's a wonderful thing. So when we have a sale, it increases on the credit side, correct? Sales return increases on the debit side. Now we have purchases and purchase returns. Purchases are an expense, they increase on the debit side. Purchase returns is that contra account, and it increases on the debit side.
On the credit.
So these go together, just like those go together.
Purchase returns increases on the credit side?
Correct.
Okay.
Because it reduces the expense.
Now, when you record that in the general journal, there's not really a posting reference for that, is there? Because
Your posting reference is this goes in the general journal, and it's going to refer to a credit memo that you were issued by the vendor. So you're going to have a credit memo from the vendor, and that's going to be in your description, and it becomes your posting reference then to your general ledger is the general journal page number.
General journal page number.
And your posting and description here that goes with your journal entry will refer to the credit memo. So there'll be a credit memo on it. Just like if it was a purchase, you'd have an invoice number. This is a credit memo number.
Well, see, like on the general journal for the sales, I didn't know what to put in this little PR thing right there. I didn't know what to, and so it,
See, when you post those to the general ledger,
uh-huh,
when you post those to the general ledger, remember you post the general ledger account number in the general journal in the posting reference column to show that it's been completed.
mhm.
Do I have anything on the slides that will show that? Okay. I think so.
So it's just the account numbers.
It's just the account number.
Oh, okay.
Just like, and I'm going to slide over here. I'm going to slide way over here. Remember when we did that journal entry a minute ago? Let's do one here. We've got January 1, we made a purchase of $500. Enter it as a debit, crying out loud. And we've got a credit to accounts payable, let's say, for $500. So this would be a normal purchase transaction. This now would go in your purchases journal, but this is what it looked like on the general ledger. On the general journal, I apologize. You would write the purchase account number here when you posted it to the general ledger, and the accounts payable general ledger account number here in your posting reference column, showing that you had done it. I'm sorry?
That's the only one usually accounts receivable.
Yeah, well, I'm sorry.
You good.
I'm making these up as I go. So does that clarify it for you?
Yes, it does, thank you.
Other questions before we move on? Okay, so that's how purchase returns and allowances works. It increases on the credit side. It is a contra account to your purchases account. You need to add them together to get the true net amount of purchases for the month. It normally has a credit balance. It is a temporary account. It is an expense account, even though, think about that for a second. It's an expense account because it goes with purchases. Purchases is an expense, purchase returns is an expense, but it's got a credit balance as a normal balance. Yes, it's a contra expense. It seems backwards, but it's normal, okay? It's okay. Think about that, get comfortable with that idea. Okay, here we go, what we were talking about a minute ago. Here's your credit memo. Credit memo number 73. January 30th, the International Apparel Shop, those guys from Dallas, Texas that sold us the suits, gave us credit for damaged suits of $476. How much did we pay for the suits?
Well, there was that plus shipping on it.
They were $476 a piece plus $360 in freight. Did we get a credit for the freight? Nope. I don't like that. I want the freight back too. Oops, I just skipped ahead on myself. So in that case, you credit purchase returns and allowances. Remember, accounts payable is a liability account. It normally increases on the credit side, and we're decreasing it. So it gets a debit. I'm sorry, I interrupted you.
Well, because we owe less on that account.
We now owe less, right. We're decreasing the accounts payable. Good? Yes? Okay. And the other thing, here's the general journal entry for this return. Notice we've got accounts payable at the top. There's the debit. Returns and allowances, the credit. Here's the posting reference, 503 for returns and allowances, 205 for accounts payable, and notice the little check mark is there. Anybody remember what the check mark indicates?
The customer.
Means that you told it to the, you already posted it to the vendor card.
Vendor card, yes, vendor card. Not the customer card, but the vendor card. And here's the vendor card here, International Apparel Shop. Notice we had made that payment. Remember we were here, we made the $2,400 payment? Now all of a sudden we got credit memo. From the general journal, page 1, we got a debit of $476. It reduced our balance. Okay? So it gets posted to the general journal, then to the general ledger, and also to the the vendor card. Okay?
Purchase returns allowance has an account number too. 503 is the account number.
Yes, that's the general ledger account number it got posted to. Good? And little arrows to show where everything flows from. And moving on. Okay. When we had the sales journal, we talked about posting to accounts receivable. And we had a schedule of accounts receivable, correct? That was simply a list of all of the customer cards and its balance. And if you totaled all those up, the total matched the balance in your general ledger account. With purchases, we're now dealing with accounts payable. So we have a schedule of accounts payable, and it is simply a listing of all of your vendors, the balance from their vendor card. When you total it up, the amount must match accounts payable in the general ledger. Good? If it doesn't, you've made a mistake somewhere, you've got to find it. And fix it, yes. Good safety tip.
Oh yeah, I found it, it's still wrong.
I highlighted it and left it wrong. That's a safety dump. Okay, so here's an example. We've got 1, 2, 3, 4, 5, 6 customers. 6 vendors. The balance that we owe each one of them totals up to $22,989. Here's our general ledger account for accounts payable, 205. And what's the balance in 205? $22,989 after calculating the balance from our transactions. Do they match?
No reconciliation.
No extra work necessary, yes. It's good, we're going home early today. Okay? Somebody perked up at that. Okay, so I believe where your question was going is, where does it show up on the income statement?
Yeah.
Okay, so where does cost of goods show? Cost of goods sold show up on the income statement.
Yes, but I missed it last week with the sales. I'm still kind of stuck in last week's stuff. I know we're going over this week's stuff, or chapter 8, but a lot of my questions that we're going to cover later are still stuck in chapter 7.
Okay.
And so I didn't know, I was referring to chapter 7, how does it show up on the net sales show up?
If you let me finish this, we will do some of those.
Okay.
So in the income statement, remember,
Chapter
how does an income statement look? And maybe I should just go forward with the slides here, but
Missed the spot.
yes. Okay, on an income statement, what goes on an income statement? What's the first thing?
Purchases or?
What's the very first thing that goes on an income statement?
Revenue?
I have revenue. Do I have anything else?
Who, what?
Who, what, and when. There we go. Always start with who, what, and when. The second thing is revenue. And we'll delve into this a little bit.
So then purchases?
Well, let's kind of work through this because I'm going to answer your question also at the same time. All right, last week we talked about having sales. Say we have sales of $1,000. And then we had less discounts of, say, $10 and less returns of, say, $90. And that would give us net sales of $900. Okay?
Got it.
Need to zoom in.
No, I'm zoomed in, don't worry.
Now what we're doing is the next step in this is normally expenses, correct? But our first expense group now becomes cost of goods sold. And under cost of goods sold, we have purchases. Say our purchases were $600, and we've got less returns, and say the returns were $50, and that gives us
Shouldn't we have freight in there too?
net cost of goods. Oh, we need freight. I skipped something. I scanned correctly. So we have freight in. And say the freight in was $10. So we've got purchases, less returns, plus freight in.
Oh, plus freight in.
Yes. Because notice I didn't put the word less in front of it. I can do two things. I can say less returns, or I can put it in brackets. So I'm actually going to spell it out that it's less returns. And from that I'm going to get cost of goods sold.
560.
And Ron is back with me in case I can't do my math. Good? Okay. What do I get? Net sales minus cost of goods sold gives me, what's it called? Anybody? Gross profit. And how much do I have? 340. After gross, go ahead, what?
And then you.
After gross profit, you would launch into your expenses. And you would keep going from there.
Now, where did you get the gross profit? By taking the 560 away from the 900, or?
Gross profit is net sales minus cost of goods sold.
Okay.
Gives you your gross profit. Are we good? Other questions? Okay. We can skip a few slides. Here's the example from what we've been working on in the slides. Remember, we made $23,315 in purchases. We had $1,565 in freight in. There's our delivered cost of the purchases. And when we get into this, we'll break down the delivered cost of purchases. To that, we'll subtract the returns and allowances. It's a little bit more detailed than I wrote here on the board, but this is truly where we want to end up going. And you get net delivered cost of purchases from this. So purchases plus what it costs to get to your door gives you gives you delivered cost of purchases. Less purchase returns and allowances gives me the net cost of all the stuff I bought delivered to my door. Net delivered cost of purchases. Good? This is a major component of figuring out total cost of goods sold. The missing element is going to involve the inventory that we had left from the end of last month and the inventory we have left at the end of this month. Okay? We'll get to that later.
I didn't get that last week, but I'll go on.
Oh. Here, take a second. Go ahead. Other questions? Yes, sir. Yes, sir.
Okay.
Okay. So, back to the things we were talking about in the, excuse me, the very first slide. We've got controls in place to make sure that purchases are authorized, that they're approved, that they actually do show up on our door because we count them and make sure that they're not damaged. We ensure that different people are approving them, are making the purchase, are checking to see that they did arrive, and a separate group making the payments.
And that helps alleviate embezzlement and theft.
Right, that avoids the problem I talked about earlier where the sales guy calls up and says, hey, I want to order 5 new MacBook Pros, can you send them to my house? Okay? And if there are documents flowing from the receiving guys through to the accounting department that yes, I did count 50 of these, they all showed up, the guy's a lot less likely to put one in his car and drive home with it that night. Okay? Questions? Answers?